When you change jobs or retire, you generally have the option to move your money from your workplace plan over to an IRA or an individual retirement account. So, is that a good idea? And even if it is the right idea, do you maybe want to wait till a certain age or wait a couple of years? That's exactly what we're going to talk about today. I'm Justin Pritchard, and we're going to go over the pros and cons of rolling over money from a workplace plan like a 401k to your IRA, where you have, again, some advantages, some disadvantages. So let's start with one of those advantages, which is control. In particular, you have control over the costs that you pay. So when you're in your workplace plan, your employer picks who the vendor is and who all the service providers are. There may be some additional fees in those types of arrangements. So you're paying people to do record keeping and administration. The expense ratios of the investments themselves might be higher than what you can get in an IRA. So when you put all of those things together, there could be an opportunity to save quite a bit by using an IRA instead of the workplace plan. Speaking of the investments, you also have a lot more control there. You can pick from the broad universe of stocks and bonds, ETFs or exchange traded funds, and mutual funds, and many other things within an IRA. But in your workplace plan, you might have a menu of just a couple dozen investments perhaps, and again, you don't necessarily pick that. Your employer generally curates that menu for you. If you'd like to get investment advice, that's a lot easier in an IRA as well. Your employer's plan may have some basic advice available. They may even have a money management option or something in there. But if you have a financial advisor that you prefer to work with, or for whatever reason you want to go a different route on the investment philosophy and all that, then you can just pick your own advisor. That's something that clients often do with me, is have me handle that since I'm doing a lot of other things. We of course go over the fees and all the other pros and cons, but if it makes sense, that's something worth looking at. And when it comes to taking withdrawals, you're in control of the tax withholding that happens when you pull money out of your IRA. But with a 401k, there would be 20% mandatory withholding, and that means it's just going to be 20% whether you want them to withhold that much or not. And the fact is that most retirees don't pay taxes at that high of a rate. Some people do, but for many people, that's just more than you need. Speaking of those withdrawals, that's another advantage of using an IRA. You have a lot more control there, and it's just easier for you to actually get the money. And that's the point of saving the money, is so that you can take it out and spend it in retirement. When you move the money over, you will take care of all of the administrative tasks and the waiting period and getting signatures that are all part of getting a 401k rolled over to an IRA. So once that's done, it's in your IRA and it's very easy to take withdrawals. You can link your bank account with your IRA, and often the funds are available to withdraw maybe the next day after you sell something. If it's a mutual fund, for example, it's very easy just to zap that money over to a bank account. Or you could have a linked brokerage account even in the same investment provider. Maybe you have a debit card there, and that money is available for spending very quickly. You don't even need to wait for, the ACH transfer, which is pretty fast, but it can take a day or two. You basically have access to that money more or less within one business day. The thing that surprises a lot of people, especially in this day and age, is that when you take money out of a 401k and put it in an IRA, they often actually cut a check, like an old paper check. And of course, that needs to go through the mail or go through a courier service at an extra fee. But either way, you have to deal with a check. You have to get it into your brokerage account, perhaps wait for the check to clear. So this is a big deal. When you can take care of that ahead of time, then the money is much easier to access when you actually want it. A couple of other advantages are going to apply to unique situations. So that might be when you die, maybe you want to have certain beneficiary options set up. And if your 401k plan doesn't accommodate that, then that's one reason to consider moving the money over to your IRA instead. Sometimes there are issues at your employer, so somebody may need to sign off on your distribution before you take the money, and that can be difficult if that person's not around. I mean, it might be hard to find the person. This is especially something that happens in very small companies. In a large organization, probably not something to worry about, but it can certainly happen at those, 10 or 15 person companies. Whoever it is that needs to sign it isn't paying attention to their email, or they are not available, or for whatever reason they just don't get it done quickly. There can also be issues if your employer goes through some sort of merger or reorganization and the 401k plan gets frozen. Maybe they're going to transfer the 401k. You might even get notification of this ahead of time, and you might think, well, I won't need the money. But if you in fact do during that period, you are forced to wait until all of that is cleared up, and then you can eventually get access to the funds. So again, this is just about making it as easy as possible for you to get the money when you are ready to spend it. This is again the whole point of saving it, and you don't want to have to deal with contacting your employer over the next whatever 5 years or 25 years that you might be in retirement. We want it to be as easy as possible for you. Once you reach age 72, you may be required to take required minimum distributions, or RMDs, from your retirement accounts. And that can be quite a bit easier if you do have assets consolidated into one or more IRAs. So when you have all of your retirement accounts in IRAs, and maybe it's a couple of different IRAs, you can take that required amount just from one of them if you want. You don't necessarily have to take a little chunk out of each, which can be convenient if that's what you prefer to do. But 401k plans don't let you do what's called aggregating those distributions. So you would in fact have to take a distribution from each 401k plan individually. And what that means is setting that up logistically, possibly paying a fee to each one of those when that happens, and keeping track of it. So if it's easier to just do that from one account or from IRAs that are again easier to deal with, I think that's potentially an advantage. One pitfall to be aware of here is that if you are still working and the company has that 401k and you're not an owner, so you want to look at a bunch of different rules carefully here. Don't just rely on this video. But if you are still working, you may be able to avoid those RMDs even after age 72. So that's one reason to consider keeping the money in a 401k. Let's look at some other reasons to avoid, or at least delay, moving the money over from your 401k to an IRA. A big one here is age 55. So if you separate from service, if you stop working at that job at age 55 or later, you can potentially take withdrawals without a 10% penalty tax. So that's the early withdrawal penalty tax, for example. Now you will probably still need to pay income tax if it's pre-tax money and would otherwise have income tax due on it, but you can avoid that penalty tax. So that's during that period between age 55 and age 59 and a half, which is when you could pull it out of an IRA without that early withdrawal penalty. So again, if you stop working after age 55, but before age 59 and a half, you might consider at least leaving the funds in your 401k for a couple of years. Also, some 401k plans are priced very competitively. This would particularly be the case, or most likely, if you work for a very large organization. So a multinational corporation or a big university or hospital system or something like that, you could potentially have a very affordable retirement plan at work, and maybe you're not going to save much or anything. In fact, you might pay more by moving the money over to an IRA. So you want to evaluate these things and just look at all of the pros and cons, and if it doesn't make sense cost-wise, then you can leave the money there. Again, look at what are the distribution options, and if those are acceptable, that's great. If you're concerned about creditor protection, whether that's bankruptcy or money you've borrowed or some other kind of liability, then this is going to be something you'd want to look at very carefully. Check with your state laws, check with an attorney who is licensed in your state to practice law, because there may be some advantage to using one or the other. So not going to get into that here, but I will leave something in the description that you can read to just get a little bit more information on creditor protection. Roth conversions are another biggie. And by the way, before I forget, please subscribe to this channel. It doesn't cost you anything, and it helps you stay up to speed on things like this. It also helps me out a tiny bit, so thanks for doing that, and thanks to everybody who's already subscribed. So when it comes to doing Roth conversions, that means taking pre-tax money in your pre-tax IRAs and converting that to after-tax Roth money. Any pre-tax money can interfere with that. It's called the pro rata rule, and it can lead to you having to pay taxes when you might not necessarily need to do that. So if you are able to keep money in a 401k, it doesn't count towards that pro rata calculation. That's a good reason to leave money or have money or even put money into a 401k if you have a Roth conversion strategy going on. Again, there are pros and cons, and sometimes it makes more sense than others. So just look at all of that in the big picture and check with a professional if you need help. If you decide that moving money from your 401k to your IRA makes sense, here's exactly how to do it. So logistically, you want to go to your employer or the former employer. That's where you're going to make the request. You generally don't go to the receiving firm or wherever your IRA is. You generally want to go to the employer, and you're going to request that they do a rollover. But it's very important to get the details right. So I'm going to tell you exactly what you want to watch for. You will typically submit that request either online or perhaps by phone or by filling out a form. Any of those will work. It just depends what you prefer and what options are available. You're going to want to have some information handy as you submit that request. So that's going to be the name of your IRA provider. It might be an investment company, a brokerage house, a mutual fund provider, for example. And an account number can be handy, not necessarily always required. And then you're going to want to decide or have an address available for where they send that check. Some places insist on or suggest that it goes to your home instead of going directly to the IRA. There are pros and cons to each. The more important thing is that the check gets made payable to your IRA and not to you personally, but you can decide where the check gets sent. To avoid a catastrophe, I cannot overemphasize this, you just want to make sure that the check gets payable to your IRA. So it might be payable to XYZ Investment Company, FBO, your name, and that FBO means for the benefit of, and this is something that if you do this on the phone with a representative, you can say, what's the check going to look like, who's it going to be payable to, that sort of thing, and that way you avoid having the check made payable directly to you. As you are going through forms, whether you're submitting this online or even having a conversation with a phone rep, you want to look for the language or say the words that you're doing a direct rollover to an IRA. That way they know not to make the check payable to you, because that will cause problems. Again, you'll have that 20% mandatory tax withholding, so not all the money is going to make it over to your IRA. It's a distribution. It could be penalty taxes on top of it, and then you would need to come up with that money that the IRS has to make the rollover whole. So that can be problematic in a number of different ways. And here's a quick tip for you. If they ask about tax withholding, if you want to have state or federal taxes withheld, that's a bad sign, because with an IRA rollover, you should not be withholding taxes or paying taxes. It generally shouldn't be a taxable event. They should be sending 100% of the money from your 401k over to the IRA without sending any of it to the IRS. So that's a red flag. You can say, wait, let's just back up and make sure that we've got this right. Is it a direct rollover from the 401k to an IRA. So I hope that's been helpful. If it has been, please leave a thumbs up. That helps me know I'm on the right track and it helps get the word out to other people. So thanks and take care.